So hello everyone and welcome to episode 3 of Apriem Financial Cents, where we're going to talk about time in the market versus market timing. I am joined by Alan Ahmatovic, who is a CFA or Chartered Financial Analyst Charter holder, and he's going to help walk us through this. Now, Alan, during this kind of time period right now, I'm getting a lot of calls from clients with the markets being as choppy as they are. They're asking me, hey, is it time to sell? Should I be selling out of the market? And so this concept or this idea of time in the market versus timing the market comes into play. It's a conversation we're having a lot. Before we jump in, could you kind of define the difference between these two for us?
Yeah, this is a real popular debate over kind of which one of these factors really matters more for investor returns over the long term. So I'll start with time in the market. So time in the market refers to just purely the amount of time that you invest in the stock market. Obviously investing, over the long term is, we're long-term investors, so we want to increase our time in the market as long as we can to benefit from the returns in economic growth that the markets provide. And then timing the market refers to trying to move in and out of the market when it essentially trying to sell high when the market's high, and then trying to buy when the market's low to try to outperform the standard return that you get from the market.
And so, I think that a lot of people can sit on the side of saying, if I have this long term, okay, I can see that just staying in the market might map out, over the long term. But what about short term? If I'm thinking short term, should I be trying to time the market in the short term if I have a short term investment goal that I'm looking at? And as we think about those two pieces, what is it that's really driving what happens in the market from both a short and a long term perspective?
Right. Yeah. So in the short term, the market is primarily driven by emotion and sentiment. And so you can see, we have this chart here, you can see in the short term, investors get greedy and they buy, and that props up stock prices. And then on the other side of it, they get fearful and they sell. So this comes from things you hear in the news, these headlines that kind of spook people out or get people really excited. So these short-term kind of emotional thinking really drives the market just over very short time periods. And here's a chart of the S&P 500, a 5-day chart that kind of displays this. So as you can see, right, both of these look very familiar. The S&P moves up one day and then it comes down another, and that's primarily just driven by investor emotions, because nothing's really changed that much in terms of the economic growth of our country over the long term, or the profitability of the companies within the S&P 500. So any changes there take a lot longer to play out, and it's not the long-term stability of them isn't really impacted by any short-term fluctuations.
Yeah, it's amazing because you think about, the first things you learn about investing, and everybody, anybody out there hears, oh, I'm supposed to buy low and sell high. But then we look at a graph like this, and we look at the 5-day chart of the S&P, and most of us emotionally, we want to buy in when everything is going good and the news is going good and everything is green, right? But then when everything is red, we get this emotional response where we want to flee and run for the hills, where at any other point in time, if it's a Black Friday sale, everybody's running to go buy their big flat screen TV at a 25 or 30% discount. But in the stock market, we do the exact opposite because it's so emotional and scary.
Right, exactly. I think a big part of that has to do with just because when it comes to money, it's a very emotional topic. So it's very uncomfortable to essentially go against the crowd and to actually buy low when people are selling, and then to actually sell when the market's up and people are buying. But really, that's to give you the best position over the long term. That's ideally that's what you'd want to do. But yeah, it is very difficult to kind of get over those emotional biases that we have, just because money is, such an emotional topic and it's such a, important aspect of our life. So it's kind of hard to treat it differently than, like a Black Friday sale or anything like that. So.
Yeah. So a lot of times, the question that I'll get, someone will call, things are going down, and they'll say, well, I don't understand why we can't just sell and sit on the sidelines, and then when things are better and things get better, then we can buy back in at that time. Wouldn't that be better than riding this all the way down and I'm going to continue to lose money, aren't I? And so what are your thoughts on that? Should we be jumping out, or should we hold through that downside as it comes?
Yeah, it's a really good question. I mean, it would be ideally that is what we'd like to do, but if we really want to do that on a consistent basis, what it really means is, if you kind of think about it from a process standpoint, what it really means is what we'd be attempting to do is we'd be attempting to predict the sentiment and the emotion of investors, and that's not really a repeatable process for us, or a way to invest that we want to rely on. So really what we want to do is we want to take more of a long-term buy and hold approach where we can benefit from our time in the market. And really this is centered around the whole idea that, the market might fluctuate in the short term because of those emotional factors that we talked about. But over the long term, we're very confident that the market is going to do well. And here's a chart here this is a 10-year chart of the S&P 500's cumulative return. So here this shows if you just simply bought the S&P 500 10 years ago and just held through the ups and downs, that you would be up approximately 137% on a cumulative basis today. And so what this shows is, we get those short-term ups and downs, but as long as our economic and political system remains in place, and companies have the ability to increase their earnings power over the long term, the market really only has one direction, and that's up. And so you can really see that here, and it might differ from year to year, and you might have bigger bumps or bigger drawdowns some years than others. Like you could see, that time in 2015 to 2016, there's a little bit of a drawdown there when we had the oil crisis. 2018, we had the big sell-off at the end of 2018 when the market got scared because the Fed was raising interest rates, and then obviously this most recent one with the coronavirus. But really, all these drawdowns have proven to be is good buying opportunities. And so that's kind of the approach that we take, and we believe that's the most prudent approach because it's the most reliable for us.
We can see that over time that it's still the S&P 500 index, but the chart itself becomes much smoother when we look at the picture from a longer period of time versus when we're looking at it over the 5-day period. The choppiness really starts to go away. And you can see that the underlying fundamentals start to become, the picture that gets painted when you look at it from a long-term picture versus the short-term up close. It's all emotion.
Exactly. Yeah, and a famous investor, Benjamin Graham, who was actually the mentor to Warren Buffett, he was quoted saying that in the short term, the market's a voting machine, and then in the long term, it's a weighing machine. So it kind of feeds into the exact idea right there.
Oh, it makes a lot of sense. And when you see it that way too, and you look at it from those two perspectives, you can see it, painted better, from that picture. And I think this answers that question of more, why should I just hold, and in the long run we can see that this maps out better for us. But I think that there's still some argument that's there. I think that yeah, I know that long term if I hold it'll map out better for me, but I think that the economy is dropping, we're going into recession. I think that now's the time to get out, and maybe once or twice I can pick those dates out. What has history kind of shown us about the ability to be able to time those periods as far as getting in and getting out?
Yeah, so the actual numbers that and actual data that we have when investors follow these two approaches is strikingly different. So we have this, we did some research and we found this chart here to kind of show how a buy and hold strategy stacks up to whatever the exact strategy is, but an attempt to time the market. And you can see that over, this starting from 2018, if you go back 30 years, 20 years, or 10 years, the result is always better if you just buy and hold the index, and that's shown in row 1 here under the untouched. And then you can see the two different the results that occur when you try to time the market. If you're timing the market and you end up missing the top 10 months added that over that time period, or the top 20 months over that time period, you end up eroding your returns, and your end result is actually much worse. This results from either investors feeling that the market's overvalued and selling and going to cash because they think it's going to drop, or if the market's come down a lot and they want to stay on the sidelines and not get back in, and then they end up missing a large rise. So really, it's no matter what's going on, this phenomenon kind of takes place. But yeah, it just goes to show you that you can't predict what's going to happen, over these short-term periods, because so much of it's driven by emotion and sentiment.
So let me ask you a question, because I think this is really interesting. You've got top 10 performing months and top 20 performing months, right? And that's missing those months. And a lot of times, I've been in this a while, and you hear these statistics based on days, right? From 1998 through 2018, there's something like 5,040 trading days. And the S&P 500 index did, an average annual return of somewhere in the range of 5.7% over that period of time. And if you miss the top 10, right, that drops down in half, about 2%. You miss the top 20 best trading days, and that drops down, and now all of a sudden you're negative, something like 0.3% by missing those individual days. Which, it makes a lot of sense. It's very difficult to handpick when those days are going to be out of 5,000 potential trading days that are out there. Why do you like showing total months versus individual trading days?
Yeah, I think the total months is better from my perspective, because we're kind of using a more long-term approach, and typically the best trading days in the market come when we're in a bear market, and we're kind of at that bear market bottom where the market's trying to stabilize and kind of gain its footing. So that when we use the top performing months, I think it gives us a better perspective from when the market's doing well and when the market's doing bad. Because when, like I kind of mentioned earlier, these numbers here kind of cover when an investor would sell out when the market's up and when it's down, and then they end up missing that the month, which is more of a longer term period. So I think it kind of paints the picture a little bit better, and and shows how valuable it is to simply just buy and hold and follow a more disciplined plan.
It sounds more realistic almost. People's emotions don't change overnight, right? Where I sold one day and the market starts jumping up the next day and I automatically jump back in. A lot of times if my emotions are saying, I think that the market's going to drop, it's going to continue to drop for a while, it's going to take me some time before I feel comfortable and confident leaning back in. So I think that this makes a lot of sense to me as far as looking at it from a monthly perspective versus the traditional, looking at days, that I could potentially miss. So
it's a good number to quote, I guess, but it's not very practical to think that, somebody's going to be able to, be in the market on those good days and then get out of the market when the next day when there's a, really bad day. So it's
right.
Yeah, if they're getting the returns on those good days, if they're taking a part of that, then they're probably also taking a part of some of the market's worst days. So it's like if you're getting one, you're also getting the other. So I'm not quite sure how significant of a statistic it really is.
So it sounds like the consensus here is that the numbers tend to tell us that historically, time spent in the market tends to outperform trying and attempting to predict what's going to happen in the market and timing the market moving forward.
Yep, exactly. I think as we kind of go over these numbers and kind of the pitfalls and benefits of both of these approaches, I think it's what we try to do is we really try to we want to define what real or more of a thorough investment operation is, and that comes down to investing based on your financial plan. And so we all have our our goals, our aspirations, our spending needs, and these are all long-term things that we're gonna be trying to achieve, or that we're going to be going throughout the remainder of our lives. So it's really a long-term kind of endeavor that we're all a part of, and so that really we should be using more of a long-term investment approach to manage that versus something short-term like trying to time the market. Really, it's the way we see it is we see it as a long, if you have a long-term goal or long-term plan, you should be using a long-term investment approach alongside with that, and that has that's more of an element of buying and holding the market versus just trying to time it.
I think that's fantastic. I would like to just kind of jump on that a little bit and say that oftentimes folks feel like when they reach retirement, that means that their long-term is no longer there. But if you're 65 years old or 70 years old and, we're looking at, 15, 20, 25, 30 years of retirement, we're still invested over that time period. We still have a long time to be invested. And yes, we're going to take withdrawals along the way, but we have dollars that are still there and still invested. And we want to be able to hold on to those long-term returns, which a lot of times means, even during periods of time like the drawdown that we've seen during the coronavirus economy, holding on is still important to hold on to those long-term returns. All right. Well, Alan, thank you very much. I found this to be very, very educational, and I hope that our viewers and listeners enjoyed it as well. If you have any questions for us, you can contact us at the office at 949-253-8888, or visit our website, apriem.com.